Okay, so now after substance over form, the next one still under faithful representation is prudence. The next one is prudence. It's still under faithful representation. So meaning that your items, your transactions, when you are not prudent when recognizing them, then you might not faithfully represent. So prudence is extremely important, that they had to reintroduce it in 2018. It wasn't there all through the 2010 era to 2018. In 2018, they had to reintroduce it in 2018. And the first thing they mentioned about prudence, right, when they reintroduced it, is that they said we have reintroduced it to support neutrality, right, to make more emphasis on neutrality. Because I just mentioned this neutrality, but it's huge. A lot of corporate fraud that happens is because they are not neutral. They are just trying to achieve, and then they are biased, right? So what is prudence itself? We are writing. Prudence is the exercise of care. Prudence is the exercise of care. The exercise of care when making judgments. When making judgments under conditions of uncertainty. Under conditions of uncertainty. So prudence is the exercise of care when making judgments under conditions of what? Uncertainty. This means that, you are writing, this means that an entity should be slow. This means that an entity should be slow in the recognition of income and assets. An entity should be slow in the recognition of income and assets, while all known losses must be immediately recognized. While all known losses must be immediately recognized. Okay. Now, the reason I gave you the next one, because that one is clearer. Saying that what we mean by to be prudent as an accountant is that you have to be slow when recognizing income and assets, while every site of expenses or liabilities, you must immediately recognize them. And that is evident in IAS 37. If you look at IAS 37, IAS 37 says that a probable outflow of economic benefits. They said you should recognize the liability. Where there is what? Probable outflow of economic benefits. They recognize it as what? Provisions. When they say probable outflow, what that means is that where there is a chance that you might pay money, right? A chance, not that you are sure, but there is a chance, like a 50% chance that you might pay money. He said, recognize that as, put it in your books as a liability. On the flip side, he said, where there is probable inflow of economic benefits, that is, if there's a chance that you might get money, he said, don't put that in your books, as an asset. He said, don't put that. That what you should do is just disclose that. Put it as a contingent asset. Don't put it in your books, right? That shows prudence, right? It's just in his attempt to comply with prudence. Though there was a lot of arguments around that when they were developing this conceptual framework, where they were trying to reintroduce prudence. A lot of argument, because a lot of people says no, that IAS 37 should be updated because it's inconsistency. Don't recognize the two sides. Don't recognize the two sides. This definition I gave you is highly theoretical. In fact, the conceptual framework, the ISB says that no, that's not what they want to achieve. He's saying that he calls situation like that asymmetric prudence, whereby a side of it is saying recognize. Another side of it is requiring more evidence before you can recognize. Right? That is what IS 37 is doing. He said that we cannot fault IS 37. That what IS 37 is trying to do is just trying to ensure that the information we give to our user is useful. Right? There were a lot of argument, a lot of wisdom that was coming, but this part wasted their time. That if they had to rely on the wisdom of the plenty of the crowd, they will not move forward. They just have to ignore it for them to move forward. But theoretically, for your exam, I think this definition I've given you will fly, right? And I'm giving you one example of prudence, right? Like that. Probable inflow, don't put it in your books. Abi? Which is contingent disclosure. Probable outflow, put that one in your books. Another example of where prudence is applied is the use of expected credit loss model. You're writing. The use of, because these are the things ICANN would ask you, right? So the use of expected credit loss model, the use of expected credit loss model in the recognition of impairments. The use of expected credit loss model in the recognition of impairment. Look up, look up. See, you will learn that later. I've not taught you expected credit model, and I'm not intending on discussing that now. But a simple example is this. With this model, if you have, for example, a trade receivables, you sold on credit. Expected credit loss model is telling you that make an assumption that the person might default, like from the date of its origination, right? Yeah. Impairments. You can say in recognition of impairment of financial assets, right? You can put it like that. The use of expected credit loss model in the recognition of impairment of financial assets. Another example of prudence is impairment of non-current assets too. Is also an area where we apply prudence. Impairment of non-current assets. Impairment of non-current assets. Okay. Now. So that first sentence I gave you when I was explaining prudence, I said it's the exercise of care when making judgments under conditions of uncertainty. See, what that one is saying with these examples I've given you is that all of this impairment and all of that, we usually make judgments. All of this, the fact that we are expecting money is judgment. The fact that we are expecting to pay money is judgment. We are saying you should exercise care because there are conditions of uncertainty. So that's why I interpreted it as be slow in the recognition of what? Income and assets. And every site of expense and liability must be immediately booked. That's all loan losses must be immediately recognized, right? In your books. Okay, so that's prudence. The last one, under faithful representation, is what we call measurement uncertainty. Measurement uncertainty. Of course, they can ask this. They can ask you to explain this with examples, really. Measurement uncertainty. Has anybody heard of it before? Measurement uncertainty. Mr. Gabriel, Stella, you have heard of it in FR. Wilson, any idea? Measurement uncertainty. Any idea? Measurement uncertainty. Okay, now to save our time, measurements. Okay, what this is looking at is that there are, in reporting, this guy is acknowledging that there are uncertainty around our measurements. And what gives rise to the uncertainty is the use of estimates and judgment, like you mentioned. So the use of estimates and judgment in determining figures gives rise to measurement uncertainty. That's what measurement uncertainty is. So when you check financial statements, at this level, you should have been reading all these publicly quoted entities, reading their financial statement. If you check the back under disclosures at the very tail end, they usually give us information or list items where they have made or where they have measurement uncertainty. So what this conceptual framework requires is that there are some estimates you make that has high level of measurement uncertainty. IS1 requires that you must disclose them, because it's very important you just know. Because high level of measurement uncertainty means that the determination of the figure is a pure guess. You just guessed. It is not based on anything. It's just like the useful life most entities use now. How can you, in the same entity, you have a Land Cruiser and you have one other car that is not Toyota, and you are saying all motor vehicles have 5 years useful life? No! Land Cruiser has a higher useful life. So useful life generally is estimates. Nobody, if I is well abused now, right, is estimates. And you see, it's guess. So saying the useful life of an asset is this, is it has high level of measurement uncertainty. So what this conceptual framework is saying is that you must identify those areas, disclose it. And if it is possible, replace those items with estimates that have low level of uncertainty. Replace it with what that has what? Low level of uncertainty. Right? So, and low level of uncertainty means that the ones that you can determine scientifically. Right? So, useful life, for example, now that we all make, is there a way we agree it has high level of uncertainty because it's a pure guess? Pure guess. So, how can we make it have low level of uncertainty? Is there a way we can make it have low level of uncertainty? Estimate of useful life. Okay, so the way it can be done is that most vehicles from the manufacturer, they will have told you that these vehicles, it can go 500 miles or the mileage is 500,000. After 500,000, the engine can knock. It will be gone. So instead of saying 5 years, why don't you just say 500,000 mileage? Then you can then determine, estimate, okay, in year one, on the basis of the mileage it has used, you use that to determine your depreciation. Maybe out of that 500, you use 100. So to know depreciation, you just be 100 over 500 times whatever you want to, whatever the depreciable amount that you have determined, right? That will have created a low-level measurement uncertainty. Okay, so that's the story behind measurement uncertainty. What I've said in total is that measurements using estimates create what we call measurement uncertainty. And we have to ensure that we replace these ones, the ones that have a high level of measurement uncertainty, with the ones that have what? Low level of measurement uncertainty. It's important for faithful representation. And if you cannot replace it, ensure you disclose it separately in your books. Okay, see, so we have 20 minutes to go. I can still do one more chapter, then we'll close for the day. You see, I took my time to explain this one, fundamental characteristics, because all the questions they have asked you in the past majorly are from these two guys. Okay, and I'll give you an assignment today around that. You can go and research on it. So your assignment, discuss. Please, you can write your assignment in your notes so that you can easily use it as your revision. Discuss the argument for and against. Discuss the argument for and against the introduction of prudence. The introduction of prudence into the conceptual framework. Discuss the argument for and against the introduction of prudence into the conceptual framework. Okay, so what this assignment will do for you is that it's going to make you understand prudence more. to make you get examples, because what ultimately the examiner was asking, this is a past question anyways, what the examiner was asking that diet was that it's just tell us the advantages and disadvantages of prudence, right, majorly. So I want to hear your views. Those that are sending me assignments, I know them. I know them. Those that are not sending me, I know them, right? So, wait, I'm looking at you for this month. Let me see whether you will change or not. Then I will know how to undo you in August. Okay, so let's go to enhancing. Enhancing has, I don't see them asking anything on this one, really. So look at it. This one, when they say that you should have a characteristics of timeliness, I don't think this one requires any introduction to you. Meaning that you should give it to the users when they need it. It's not more than that. Provide the report to them when they what? Need it. Understandability means that it should be concise and straightforward. Should be concise and what? But there's a caveat in understandability. We're not saying you should remove complex items. Right? Some items are complex. And they not even went ahead and said that a user is not just anybody, it's somebody with reasonable business and accounting knowledge. Right? So that's why investors will come and meet us. That's why you guys are here. Investors will meet you that, please, explain this to me. So it's not a problem where professionals like you guys cannot understand it. There's a problem, right? Comparability, as the word implies, we should be able to compare it with other entities' financial reports, and we should be able to compare it through time. That is, we should be able to compare year 1 with year 2, right? Verifiability means you should be able to check it for correctness. You should not provide a report that nobody can reconfirm it, right? Independent professionals must be able to look at the value of, let's say, your PPE. From the figures in your financial statement, meaning they should be able to go to your notes and be able to recalculate it, and get almost similar results. Not necessarily the same, but similar. So verifiability means we should be able to recheck it for accuracy, or we should be able to recalculate it for accuracy. That is what verifiability is talking about, and that's the qualitative characteristics. Please. Wow, wow. Good, very, very good question. Very good question. Yeah, so I kind of asked that before. They have asked it before. Okay, so everything is still around measurement uncertainty. That's one. 2, the way we prepare accounts has resulted in that. So there's something we call earning quality. Earning quality. So ordinarily, profitability should be very close to cash flow. The guy is right. A business person is right. You cannot say you have profit of 1 billion and you don't have 10 million in your account. That means that your earnings lacks quality. So it's part of the things we are going to discuss in analysis. When we're analyzing financial, we'll talk about analysis of cash flows. So your earnings must have quality. And I kind of asked you before that you should explain earnings quality and what are the issues that can result in not having any quality, or how can you achieve earnings quality, right? So the way, like items like depreciation, for example, causes that disparity. Items like impairment, for example, causes that disparity. Items like accruals, for example, causes that disparity. But we want to ensure that over time it should smoothen out, right? They should pay. Over time, impairment should reverse. Over time, all of these things should balance up over time. But by the time the disparity or the difference between your profit and your cash flow is becoming wider, is a problem. Your earnings must have quality. The cash flow and the profit must be the same. So you need to be able to convince the guy and explain why, what is causing it, and if possible, close that gap. Okay? Well, that's no. For you to have profit, that asset must have generated income or revenue, and the expenses you have incurred. You know, assets. The cost of the asset doesn't come in as a deduction from your revenue. So the fact that you have acquired assets should not impact your profit, right? But when you say that, so you cannot translate. That's what I'm trying. Let me not talk too much on that. So if you have capitalized or invested, somebody will know, an investor will know that, okay, yeah, that he's not expecting that to be profit. Do you get that? He's not expecting that asset to be profit in the immediate time. No, that's not why. That's not why. So, like I've said, assets will generate income over time. Okay? And a businessman, we know that, okay, I've invested this one is gone. So what the businessman will not understand is the one that I can see that I'm expecting today. You told me that I sold 10 million and I incurred some expenses. So why am I not having over 2 million? Why am I not having 8 million cash? That one is what is. So the guy will not expect that, okay, I invested 10 million. You will not expect that to translate to cash in the immediate time. But by the time he's not seeing 10 million, then we'll start talking about depreciation, accruals, and all of that. Okay, so we will get there. It's something we'll discuss at this level. Okay, so in addition to what you have said, finally, is something we call cost constraints. Cost constraints. And how do we write that? Cost constraints. What that means is that in ensuring that your financial reporter's quality meets these characteristics, you must ensure that the cost of preparing these reports does not outweigh the benefits. Okay? So there's always this caveat at the end of chapter 2. It must never outweigh the benefits of preparing the reports. So the remaining 10 minutes, I'll quickly look at chapter 3. Then we have to continue next week. Or when is this class ending? Or is it 1:30? When is this class ending? So, in fact, the chapter 1 and chapter 2 are the major ones. The chapter 3 to chapter 8 are short. So this one, I'll explain it in 5 minutes or less. So, and I don't see questions coming from chapter 3, right? So this one is just financial statements and the reporting entity. So the first thing is it tries to explain the perspective of a financial statement. Okay, so chapter 1 talks about the objective of a financial statement. So it's not going to repeat that here. So what this is talking about here first is the perspective of a financial statement. The perspective of a financial statement. And the key question here is that when we are preparing financial statements, we should prepare it from the perspective of the reporting what? I mean, this one is just emphasizing the fact that you have to report merely the economic activities of the company. So don't prepare from the perspective of the users that you want to satisfy somebody. No, is the entity you should present to us. So that's the first thing this explains in the conceptual framework. The perspective should be perspective of the reporting entity. And the second one is the reporting entity itself. So this chapter 3 tries to describe what a reporting entity is, and also he also gave us like the boundary of a reporting entity. Like this is the boundary. After this is not a reporting entity. So in describing a reporting entity, the first thing he said is that a reporting entity is an entity that chooses to, meaning it's not compulsory for them, or is required to. It's either they choose to or they are required to. Okay, so those ones are required to. Majorly companies that are quoted or listed on the market, they are required. It's compulsory. While some other companies like private entity, they just choose to. It's not really a requirement for them. They can just maintain anything and just move on. Just for them to know their expenses and income. And again, a reporting entity, he said, can be a part of a single entity. Part of a single entity, and this is like an operating segment. In fact, we'll look at the standard very soon, IFRS 8, on operating segments. And last night, they flooded your questions with operating segments. Okay, so we don't know what will happen this night. Or it could be a single entity itself. A reporting entity can be a single entity, or it could be group. It could be group of entities. That's also a reporting entity. And it's not necessarily a legal entity. So a reporting entity does not have to be a legal entity. Meaning, for you to comply with this conceptual framework or IFRS, you don't have to be a company. It's a company like or limited liability companies that are legal entity. It could be a sole proprietorship business, even if it could be a partnership business. It doesn't have to be a legal entity, right? And again, the boundary is that it must be a going concern. So if you just set up a business and your intention is to just run it within 1 year or 2 years and close it, you cannot report in line with IFRS because there will be a mismatch. How will you determine depreciation, for example, now? How do you want to depreciate your assets when you will even be there after 2 years? So for that reason, they say that before you can be a reporting entity, you must have the intention to operate into the foreseeable future. You must not have intention to liquidate or terminate or stop operation in the short term or even in the long term. You must be ready to operate into the foreseeable future. And that is it about chapter 3. Thank you.